Wells Fargo is a particularly agile company. Principally, Wells Fargo has 1. Developed peripheral vision and avoided becoming blinkered. 2. Experimented with new business models. 3. Encouraged dissent and avoided groupthink. 4. Built the capacity to act quickly. And 5. Flattened and simplified its structure. Tool 1. Wells Fargo operated like a mini Citicorp in the 1970s, pursuing multiple business lines in multiple geographies. However, by the end of the 70s, with slowing domestic demand and weak international operations, the CEO realized that Wells Fargo would never become the leading international bank and a new strategy was required. At the time, the majority of the banks in the US built their strategies around maximizing a simple economic driver, profit per loan. Consequently, all strategy operations and processes looked to maximize bank lending. Wells Fargo realized that in a deregulated world, retail and commercial lending would become increasingly commoditized, and that the key economic driver would no longer be profit per loan, but profit per employee. The bank subsequently chose to relentlessly attack costs, eliminating 100 branches, cutting 3,000 jobs, and closing down the bank's European offices, at a time when most banks were expanding their overseas networks. From this highly profitable, culturally aligned base, Wells Fargo would go on to dominate its core market and significantly outperform the S&P 500 over the 1990s. Tool 2. Companies are consistently challenged by disruptive technologies that change the shape and terms of competition. Before the 1990s, banking was predominantly conducted face-to-face, and banks invested significantly on the breadth and appearance of their branch networks. In the US, this led to a fragmented market of regional banking champions, with First Interstate leading in California. Wells Fargo, in contrast, held the number 2 position. Against this traditional backdrop, however, the emergence of the internet would change the face of banking forever. In 1995, Wells Fargo partnered with Cybercash, a software startup, to begin offering its services over the internet. Wells Fargo was the first US bank to provide online banking and quickly expanded its online offering to include market-leading business banking and corporate banking offerings. Wells Fargo kept an eye open for what was happening at the margins of banking. In contrast, First Interstate continued to focus on face-to-face banking and was saddled with a high cost base that it entailed. By the end of 1996, the cash flow generated through the increased application of technology, both through the internet and an increased availability of ATMs, were key to the successful takeover of First Interstate Banking Corporation by Wells Fargo for $11.3 billion. Tool 3. In the early 2000s, loose bank lending significantly increased the availability of credit to low-income households. The resulting US housing bubble came to an end in late 2006 when increased interest rates led to widespread foreclosures. Lenders and issuers of subprime mortgages immediately became embroiled in the crisis. However, despite being one of the top 3 issuers of mortgage-backed securities in 2006, along with Countrywide Financial and Lehman Brothers, Wells Fargo largely avoided the crisis. Despite the widespread market opinion and significant investor pressures during the boom years, Wells Fargo maintained a contrarian view and stayed out of exotic mortgages in the early 2000s, actively choosing to shrink its market share as a result. However, this reticence paid off, as Lehman Brothers entered Chapter 11 and Countrywide required a forced sale to Bank of America to avoid a similar fate. In turn, this decision hobbled Bank of America and allowed Wells Fargo to steal significant mortgage market share, this time on the lower risk terms with which it was comfortable. Today, Wells Fargo is comfortably the biggest mortgage originator in the US, with almost a third of all new mortgage loans. Tool 4. As the credit crunch showed, financial markets are highly unpredictable, and it is very difficult to estimate when the next big opportunity or threat is going to hit. In 2008, Wachovia was the 4th largest bank holding company in the US, but was in deep trouble. Exposed to highly risky loans, it reported a loss of $8.9 billion in the second quarter of 2008. In contrast, with its more conservative lending practices, Wells Fargo had actually turned a small profit over the same period. With this financial strength, Wells Fargo was one of the few banks with a financial security to purchase Wachovia, and in September 2008, it made a bid to do just that. In October, Wachovia accepted Wells Fargo's offer for $15.1 billion. The acquisition would create a superbank with $1.4 trillion in assets and 48 million customers. Tool 5. Agile companies rely on the whole organization to be innovative and take advantage of new opportunities or respond to threats. This requires decision-making to be pushed down to the lowest level by creating a flat organization with clear lines of accountability. Wells Fargo has leveraged a range of innovation centers to achieve this goal and bring new products through from design to implementation. In online and mobile banking, Wells Fargo relies on an internal incubator established in 2006 to accelerate advances and reduce the speed to market. Wells executives credit the incubator for it taking just 67 days to move new mobile banking applications from development into customers' hands. In summary, Wells Fargo has successfully used agility to mitigate the threats and take advantage of the opportunities in the US banking sector over the last 3 decades. After the financial crisis, these tools will continue to allow it to grow in an ever